Ever notice how gas prices seem to change overnight? One day you're filling up your tank at a reasonable price, and the next, it feels like you're paying a lot more for the same amount of fuel. It's something that affects almost everyone, whether you drive daily or just occasionally. That's the global oil market at work. Oil is traded around the clock, across continents, and its price is influenced by everything from international politics to natural disasters. A single event halfway across the world can send prices soaring or tumbling, and those changes ripple out to every corner of the globe. Crude oil powers our cars, heats our homes, and is the backbone of products from plastics to fertilizers. It's not just about fuel. Oil is a key ingredient in thousands of everyday items, from the packaging on your groceries to the materials in your electronics. When oil prices rise, it's not just the gas pump that gets more expensive. Shipping, groceries, and even plane tickets can cost more. The cost of transporting goods increases, and those extra costs often show up in the prices you pay at the store or when you book a flight. Businesses pass on higher fuel costs, so you feel it in your daily expenses. Whether you're a shopper, a small business owner, or someone who relies on deliveries, rising oil prices can squeeze your budget in unexpected ways. Even the plastic in your fridge and the asphalt on your street are tied to oil prices. From the roads you drive on to the containers that keep your food fresh, oil's influence is everywhere, often in ways you might not realize. When oil gets pricier, inflation can follow, making your money stretch less. As costs rise across the board, your paycheck might not go as far, and everyday essentials can start to feel like luxuries. So, when you hear about OPEC Plus meetings or global tensions, remember, those headlines can hit your wallet. Decisions made by oil-producing countries or sudden changes in supply and demand can have a direct impact on your cost of living. Oil's story is global, but its impact is personal. Understanding it helps you navigate your own budget. By staying informed about oil prices and the factors that influence them, you can make smarter choices and better prepare for changes that might affect your finances. As 2026 begins, the world's energy markets are waking up to a new reality. After a year of volatility and uncertainty, oil prices are showing the first signs of a cautious recovery. Oil prices are inching upward after a tough year, with traders and analysts alike watching every move for clues about what's next. On January 2nd, Brent crude rose to just under $61 a barrel, a level not seen in several months, sparking cautious optimism among market participants. Meanwhile, WTI hit about $57.50, reflecting a similar upward momentum in the U.S. market. These small gains mark a shift after a nearly 20% drop in 2025, the steepest since 2020. That dramatic fall left producers and investors reeling, forcing many to rethink their strategies. Now, traders are keeping a close eye on new risks. Geopolitical tensions in key oil-producing regions are simmering, and any escalation could send prices soaring. OPEC Plus decisions are also in the spotlight, as the group weighs whether to tighten supply in response to shifting demand and global uncertainties. The market mood has shifted from oversupply worries, with storage tanks once brimming, to a more cautious outlook. Now, concerns about potential disruptions, whether from conflict, weather, or technical failures, are taking center stage. Investors are weighing last year's surplus, which kept prices low and gas affordable, against fresh threats that could limit production or shipping. Any disruption, be it a blocked shipping lane or a damaged pipeline, could quickly tighten the market and push prices higher. For now, the price bump is modest, but it's enough to catch the attention of consumers and businesses alike. Some drivers are already noticing slightly higher prices at the pump, raising questions about whether the era of cheap gas is coming to an end. The market is holding its breath, waiting to see which force, leftover surplus or new risks, will win out in the months ahead. These early moves could be the first sign of a bigger shift ahead, as 2026 sets the stage for a potentially dramatic year in global energy markets. To understand today's price uptick, let's rewind to 2025, a year defined by a dramatic oil price slump. Crude prices fell nearly 20%, the biggest drop in years, despite ongoing global tensions. The culprit? Oversupply. Oil producers pumped far more than the world needed. OPEC Plus and others ramped up output, flooding the market and filling storage tanks worldwide. Meanwhile, demand lagged, especially in Asia and Europe, where economies slowed. Less travel and weaker industry meant fewer buyers for all that oil. The result: sellers slashed prices to compete, and the market absorbed shocks without spiking. Even with conflicts, the sheer volume of oil kept prices low. Now, as 2026 begins, the big question is whether that era of oversupply is ending. Are the forces that drove prices down finally fading? The 2025 oil slump was all about supply. OPEC Plus gradually reversed earlier production cuts, swelling global output. Non-OPEC producers, especially the US, kept pumping at record levels. Shale oil added millions of barrels daily. The result? A market awash in oil, with storage tanks brimming and prices sinking. This oversupply acted as a buffer, making the market less sensitive to disruptions. Even conflicts or threats to supply barely moved prices. There was simply too much oil. Buyers had leverage, demanding lower prices in a crowded market. This dynamic dominated 2025, setting up the price correction we saw. Now the focus is on whether producers will finally cut back to drain the surplus. Will they act to bring prices back up? The answer will shape the market in 2026. When oil prices move, OPEC Plus is usually behind it. OPEC, founded in 1960, now includes 13 countries aiming to stabilize oil markets and secure steady income. In recent years, OPEC joined forces with non-members like Russia, forming OPEC Plus. Together, they control over 40% of global oil production, enough to sway prices worldwide. Their meetings are closely watched. Decisions to cut or boost output can send prices soaring or tumbling. OPEC Plus analyzes demand, inventories, and economic forecasts before setting production targets. If the market's oversupplied, they cut. If prices are too high, they might pump more. Their choices ripple through the global economy, making their next meeting critical. OPEC Plus acts like the central bank of oil, managing supply to hit their price goals. That's why their decisions matter to everyone, from traders to everyday drivers. All eyes are on the OPEC Plus meeting set for January 4, 2026. After last year's steep price drop, their top priority is stabilizing the market. Most analysts expect OPEC Plus to stick with their current policy. No new output increases for now. This defensive move aims to let demand catch up and drain the surplus. The group is shifting from chasing market share to defending profitable prices. Holding production steady may sound simple, but it prevents another price collapse. The market will be watching for any hints about future moves. For now, OPEC Plus is signaling caution and a desire for stability. Oil prices aren't just about supply and demand, they're shaped by global events. As 2026 begins, two hotspots are raising anxiety: Venezuela and the Russia-Ukraine conflict. The US recently imposed new sanctions on firms helping Venezuela export oil, tightening global supply. Meanwhile, renewed fighting in the Black Sea threatens key shipping routes for Russian oil. Attacks on ports or tankers could disrupt exports, making oil harder and riskier to move. Even small disruptions can send prices higher, as traders fear bigger shocks ahead. This is the geopolitical risk premium, the extra cost built into oil prices due to uncertainty. News from Washington, Moscow, or Caracas can move markets instantly. These tensions add another layer of volatility to an already delicate balance. That's why geopolitics matter as much as barrels and budgets. Sanctions and conflicts might seem distant, unfolding in faraway countries or on news tickers you barely notice. But the truth is, these global events can hit your wallet faster than you think, often in ways that are both direct and surprisingly personal. For example, when the US clamps down on Venezuelan oil with sanctions, it's not just a political move. It means less oil is available on the world market, shrinking global supply and causing prices to rise everywhere, not just in Venezuela or the US. The same goes for risks in the Black Sea. If there are attacks on cargo ships or insurance costs skyrocket due to conflict, oil can get trapped in ports or at sea, making it even scarcer and driving prices up further. Even if oil wells keep pumping, if the oil can't be shipped safely and efficiently, it's as good as gone for the people who need it. Supply bottlenecks can be just as damaging as actual shortages. Each disruption, no matter how small, adds up. Traders on global markets watch these events closely, and even the hint of trouble can make them nervous, causing oil prices to spike in anticipation. The fear of shortages often becomes a self-fulfilling prophecy. When investors and traders expect prices to rise, they buy up oil futures, which pushes prices even higher, sometimes before any real shortage occurs. higher oil prices ripple through the entire supply chain. Refineries pay more for crude, truckers spend more on fuel, and factories see their energy costs climb. Every link in the chain feels the pressure. Eventually, those higher costs get passed on to you. At the gas pump, in the grocery store, and when you open your utility bill. Everyday essentials become more expensive, and your budget feels the squeeze. This is how distant headlines about sanctions or conflicts become real-life price hikes that affect your daily life, even if you're thousands of miles away from the source. The global oil market is deeply interconnected. Every shock, no matter where it starts, sends out ripple effects that can be felt around the world, impacting economies and households everywhere. That's why staying informed about global events isn't just for investors or politicians. It matters for everyone. Understanding these connections can help you make better decisions for your own finances. Your household budget is more connected to world events than you might think. The next time you see a headline about sanctions or conflict, remember, it could be the first link in a chain that leads straight to your wallet. As 2026 unfolds, the oil market is pulled between last year's surplus and new upward pressures. OPEC Plus's next move and simmering geopolitical tensions could keep prices climbing. If supply stays tight and conflicts persist, expect higher costs at the pump and for businesses. But surprises, like a sudden production boost or peace deal, could send prices down again. The global economy's strength is another wild card. Weak demand could undermine any price rally. Oil remains volatile, and its price is a key signal for the world economy. Whether you're budgeting for your family or running a business, oil prices matter. Staying informed helps you prepare for whatever comes next. The story of oil is the story of our economic future, one worth watching closely.